TheoTrade. This is Don Kaufman. It's March 1st, 2023. There are 20 minutes left inside of the trading day on this Wednesday afternoon. S&Ps are down some 20 handles in what has been, a very slow, grinding day to the downside. Of course, the topic of conversation here of this evening's video: will inflationary fears overwhelm markets? All right, so why the discussion at this point in time as markets are grinding a little bit lower? Why do we jump back and start talking about inflationary fears? Let's get right to the crux of this evening's video. All right, my cause for concern is right here inside of the ZB. If you're unfamiliar with the ZB or ZN, all right, the ZB is the 30-year U.S. Treasury bond futures contracts. Of course, the ZN is the 10-year. Nevertheless, it's the ZB that, well, I construe as a little bit more of a retail-friendly trading product. And I have to tell you, the current trend inside of ZB, it's beyond alarming. The current trend inside of the ZB has officially broken to the downside. Now, if you're taking a look at the chart with me on the screen at present time here on thinkorswim, let me tell you something. You need to contract adjust your chart. And it's something that a lot of people will miss. They don't know about like continuous contracts or futures contracts. Look, the bottom line is very, very simple. We just went through a recent roll. What is a roll? It's basically one contract ends and another one begins. But when it starts to come into certain futures contracts, specifically in bond contracts, there can be as much as a point difference between, well, one contract and the other. The example right now is absolutely perfect because, if you take a look at the March contract, it was trading 123. We're now trading closer to almost 124. There's almost a point differential between those two. Nevertheless, what I am trying to get at is, a lot of people are looking at this chart and quite frankly, you're just not looking at it right. You need to actually come up here specifically on thinkorswim, click the little sprocket, come over to where it says futures contracts. Under futures contracts, adjust for contract changes. Now watch right over here. Okay, in fact, I'm even going to circle it. You want to watch right there. And I'm going to go ahead and hit apply and okay. Did you see? It's magnificent. Look, the bottom line is the bonds are selling off. Rates are actually creeping back up. And it's to almost what I would construe as the breaking point. If we get any more sell side activity inside of the ZB, it just like this marketplace, it's gonna snap. And you may not feel it right now, but again, those bonds, this is a very pivotal area. Now, there's a lot of different ways you can look at rates. Like, look, that's the ZB, which actually, you can bring up what's called TYX. TYX is actually the 30-year. It's approaching 4%. You could also look, of course, at TNX. TNX literally is sitting at the 4% level. And the reason that I'm actually bringing up TNX is, as I was saying, those bonds, those notes, they're right there to it. So the bonds selling off, the notes selling off, okay, implies, of course, higher interest rates. Now, again, a lot of people, of course, will talk about, Fed fund futures till they're blue in the face. But here's the bottom line. The Fed predominantly controls, if you will, the shorter end of the curve. When you start thinking about the Fed, right, you really want to start thinking about Fed fund futures, which is like overnight. You want to think about, like 2-year. By the way, you can look at the 2-year, probably the easiest place to look at the 2-year. Come over here to TastyTrade. Cruise on TastyTrade over to futures contracts, go to the small exchange. Small exchange actually has the 2-year listed over there. The 2-year is almost at 4.9. I mean, it's skyrocketing, but push all of that aside because I'm going to tell you right now, the Fed fund futures and the Fed actually driving rates higher doesn't necessarily always pertain to like the 10-year. It's the 10-year though at this point. It's on its own right now, and it clearly sees inflationary pressure. It clearly sees that, that 4%, that might be the trigger where all of a sudden the Nasdaq just has had enough. It's growth stocks. Okay, it's like your Microsoft, your Apple, your Amazon, okay, possibly even your Meta, your Tesla. And I know that Tesla has the investors day, but neither here nor there, your Nvidia. These are the stocks. They can get annihilated. okay? And at some point it's going to feel like literally like it snaps. I am telling you, we are right on the verge of that. So again, that big question, those inflationary fears, okay, I do believe they will overwhelm the markets, but it's largely predicated on this TNX cracking above the 4% in my mind is a key threshold. And to say we're right there is an understatement. I mean, look, we're trading 3.994. Doesn't get any closer than that, people. If you actually look on an intraday basis, we did in fact clip to the 4% level inside of the TNX. All right, so that is what I wanted to imply by inflationary fears kind of overwhelming the marketplace. And again, those interest rates, they see it. I mean, rates, they're taking off to the upside. I mean, coming off 3.4% to 4% in again 3.4% to 4% in a matter of a month is again a phenomenal move inside of that 10-year. All right, let's push that aside for just a second, get down to business inside of the broader marketplace. So the S&Ps kind of feel like they're just grinding this week. In fact, to take a look at the entire week, I'm not even going to use the S&P futures. I'm actually going to jump immediately to the SPX, as I term the SPX the mother of all products. And the reason I'm actually cruising over to the SPX is to just kind of delineate really quick how slow the week has actually become. One of the first things that I want to mention, even before I look at price action over here inside of the S&Ps and SPX, but one of the key things I wanted to mention is the OCC report, which is the Option Clearing Corp, really, really off this week. We've been averaging this year, so in 2023, the number of option contracts we've been trading is close to about 46 million contracts a day. Like yesterday, did about 37 million. Today is going to be light. The day before that, we were at like 36 million. I mean, we're like 25% off in terms of volume. Now, everybody's talking about, 0-day expiration, but I'll be very frank in saying there's not a lot of activity going on. Not short duration, not longer duration. Volumes being off by 20 or 25%. There's just not a lot of commitment to trade. Which, if you look at that, you're like, well, okay. Well, look, it should make you a little bit nervous. And I'm going to tell you exactly why it should make you nervous. Because if you take a look at the SPX, the SPX is slated to move this week approximately, plus or minus $76. Actual move this far, like, do we even need to measure it? Okay, we have done absolutely nothing. I mean, it's like a rounding error at this point of some of the trade activity. We opened up on Monday a little higher. We faded off that. On Tuesday, we faded off that. Here we are. Ultimately, on Wednesday, we sold off. We actually rallied back up a little bit. Yada, yada, yada. Got nothing. Tesla has an event. It's after the close. It really kind of kicks off. That could be a bit of a market mover. CRM, Salesforce got some earnings after the bell. That's not really going to be much of a market mover. But again, you're in a marketplace that just doesn't feel like it has a tremendous amount of catalysts. And it's one of the reasons that I'm keying into the bond marketplace, because the bonds, it's almost like nobody's paying attention right now. They're like, hello. Bonds are actually trading like the 123 handle. Wake up! We're about to hit like 4% again on the 10-year, and everybody's kind of asleep at the wheel. So I'm going to caution you for Thursday and Friday this week, and I say this a lot on the Wednesday night videos. Like, you need to fully anticipate, people, there's going to be some big boy activity here. You can hit the upper or lower edge of the expected move. Now, to be very, very specific in here, and I like to be specific, is I have skin in the game. Like, I'm absolutely short the marketplace. But on a day-to-day basis, we have just been trading kind of at a hairpin trigger, higher or lower, right? Every day almost feels like it's trading in a degree of autonomy. And that's what you get when you've actually got like a little bit of a lower liquidity slop fest. Nevertheless, this can turn into a high impact marketplace in no time at all. It's a market that is simply searching for any catalyst that can latch onto. And when you start to look, at some of the catalysts tomorrow, some ECB minutes, the jobless claims, there's a lot that could technically impact markets. Nothing as considerable as today. Nevertheless, as I was saying, it's a bit of a slop fest. Well, until it's not. Okay. One of the things, though, that I think you absolutely have to consider for the remainder of the week is some very, very key levels. One of which I had mentioned back on the weekend update, and it is incredibly, incredibly valid because we are so close. Okay, to the downside of this marketplace, here we sit just above the 39.31. It has yet to have made an appearance this week. We got down all the way to 39.43 today. We actually missed it. Nevertheless, I'm still looking for that to make an appearance as this week progresses. To the upside, again, I just could we actually have a bid to the upside? Of course, I've got nothing north of us right now, meaning that no key levels here other than the fact that we have an expected move, and that expected move, the upper edge of the expected move sits somewhere. I'm just going to key into it right here around 40, 45 in the S&Ps, right? That's pretty significant move, obviously, to the upside. But again, that 39.31 carries tremendous weight to the downside. Let's see if it'll make an appearance here in this Thursday or Friday of trade. I cannot stress enough. Do not let, okay, some of the complacency, okay, the lack of urgency to trade get you off your game in here. Just between, again, today and, of course, March 3rd, end of the week, you're still projecting in the S&Ps about a $50 move. I anticipate we're still going to actually tag the upper end or lower edge of the expected move. A market just looking for catalysts is a market, okay, ripe for big movement. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.